Following on from our last episode, we've now scrolled down and we're looking at another basic source of information that Google gives us. Now, this is the quarterly financials, and once again, we're looking at Murphy's Oil, and you can see straight away here that the numbers are horrendous. They're all red, and as a quick disclaimer, they're all red at the moment because coronavirus is here, business has shut down, all of the companies, especially oil, are in a bit of trouble, shall we say. But first up, we can see, obviously, it's given us the currency, it's given us the date, and it's given us the year. Now, we are looking at quarterly financials, and these financial reports are for the first 3 months of the year, from January 2020 to March 2020. There'll be a second quarter report from March to another 3 months on, and there's 4 of these each year. Now, these quarterly financials don't come out till after 3 months has passed because takes time to collate all the data and everything like that. And we can see straight up revenue for the first quarter for Murphy's Oil was 600 million. That is down 4.58% year on year. So that's relative to the last year. And what does this mean? Revenue basically refers to the price of all the goods sold times the quantity of the goods sold. The higher revenue, the bigger the company. The higher revenue, the better. I mean, a company with no revenue would have no demand for products. And revenue is largely always is relative to the size of the company. It is important, but the more important one is the net income, the net profit margin, and the diluted earnings per share, which is below. So the net income down 1,135%. Oh my goodness, that is crazy. But as I say, because business shut down in the world. Now, the net income is basically an entity's income minus the cost of all the goods sold, the expenses, the depreciation, that means wear and tear of machines, how much value was lost due to using these machines, the interest minus the tax, minus the dividends, preferred dividends. And you can see deducting that from the company's total revenue gives us the net income. And the net income here is minus 416 million. And it basically means that the company has got more costs in this first quarter than it does revenue. And that is a very, very worrying sign in normal circumstances. No way would the company continue to survive making such a big net income loss unless it was, it's very exceptional circumstances right now. But yeah, it's not good. Next up, we have diluted earnings per share. Now, this is a bit of a tricky one. Now, a company's diluted earnings per share is the net income minus preferred dividends by the weighted average of the number of shares outstanding, plus the kind of impact of convertible preferred shares. It basically all gets very, very complicated. And I think when you're a beginner, there's no point looking too much into this at the moment. But when diluted earnings per share is negative, it basically means the company is losing money because earnings per share, how much earnings does one share have? But when it's diluted, it's just slightly reduced a bit because it's taking into account other variables that earnings per share doesn't. But let me talk about earnings per share. I know it's not on here, but basically earnings per share, if I sold $100 of goods and I only had 5 shares outstanding, or let's say no, I sold $100 of goods in the year or in the quarter, and I had 10 shares outstanding. Given I had 10 shares outstanding and $100 of revenue, my earnings per share would be 10. So it's revenue / earnings divided by the shares outstanding. So the higher earnings per share, the better, of course, because it means the company's just earning more. Your share is worth more. It generates more earnings, if that makes sense. And then the net profit margin is the percentage of revenue remaining after all the operating expenses, interest, tax, and preferred stock and dividends, but not common stocks and not normal stock, have been deducted from a company's total revenue. Now, basically a preferred stock dividend is you can either buy preferred stock or common stock. Now, preferred stock basically means that in the case of, bankruptcy or in general, you get paid your dividends first. And common stock people, the people who like me, who buy it on the normal market, we have to wait a bit longer to get our dividend payments. So it's a bit more of a risk. But yeah, you can see some very unhealthy financials here. But you can't read too much into them during this unprecedented time. But yeah, let's jump into the next episode where we are going to be talking about using the Google News function.